Understanding cash flow versus profit. Many business owners mix up cash flow with profit, but they serve two very different roles. Profit shows you whether your company is financially healthy on paper. Cash flow shows you whether your business can stay alive day to day. Profit is the amount left after covering all expenses. Cash flow is the actual movement of money in and out of your business. You can show a profit on your financial statements yet still struggle to pay bills if payments from customers are delayed or if too much money is tied up in inventory. Think of it this way. Profit tells you if your business model works. Cash flow tells you if you can keep the doors open. When you understand both clearly, you gain a stronger view of how your business is performing and where adjustments need to be made. This awareness helps you avoid surprises, plan ahead, and keep your finances steady even when things get unpredictable. Understanding cash flow versus profit. What makes cash flow different from profit? Profit shows what remains after subtracting expenses from revenue. It's useful, but it doesn't tell you how much money is actually available for day-to-day operations. Cash flow reflects the actual movement of money in and out of your business. It shows when money arrives, when it leaves, and whether you have enough on hand to cover urgent needs. Why businesses can be profitable but still struggle. Plenty of businesses look good on paper yet still feel financially tight. Profit doesn't guarantee cash in the bank. When customers pay late, when inventory ties up your money, or when unexpected costs appear, you can run short even if your income statement shows success. That gap between profit and actual liquidity is what pushes many businesses into stressful situations. Once you understand this difference clearly, you're better equipped to plan for slow periods, avoid assumptions, and maintain stability through unpredictable cycles. Common causes of cash flow problems. Operational issues that affect cash flow. Many cash flow challenges come from everyday processes that don't get enough attention. Delayed invoicing, slow collections, long payment terms, high overhead, and poor tracking habits all create hidden pressure. Even something as simple as forgetting to follow up on overdue payments can lead to major shortages over time. Growth-related cash flow challenges. Growth brings opportunities, but it also demands more cash upfront. Hiring new people, buying equipment, stocking more inventory, or moving to a larger space all require capital long before revenue increases. If payments don't come in quickly enough, even a growing business can hit a cash crunch. Spotting these pressure points early helps you adjust payment terms, monitor spending more closely, or strengthen your collection process before problems escalate. How to forecast cash flow accurately. Steps to create a reliable cash flow forecast. A strong forecast is built by laying out every expected inflow and outflow. This includes projected sales, payroll, supplier payments, rent, utilities, loan obligations, seasonal trends, and any one-time expenses that might be coming up. Using past financial data helps you create projections that reflect real patterns rather than guesswork. Updating your forecast each month gives you a clear view of what's ahead and allows you to adjust quickly when plans change. Benefits of effective cash flow forecasting. Forecasting helps you spot potential shortfalls before they occur. When you know a tight period is coming, you can shift budgets, negotiate with suppliers, delay non-essential spending, or look for temporary funding. Instead of scrambling in a crisis, you move with intention and stay in control. A reliable forecast strengthens your decision-making and gives your business the financial stability needed to pursue long-term growth without panic. Tools to simplify cash flow tracking. Digital tools that improve cash flow visibility. Modern accounting platforms make cash flow easier to monitor. Software like QuickBooks, Xero, Zoho Books, FreshBooks, and Wave tracks income, categorizes expenses, automates billing, and provides real-time dashboards. These tools give business owners a clear view of financial activity and help identify trends early. Why automation helps prevent cash flow issues. Automation reduces human error and keeps important tasks from slipping through the cracks. Automated invoicing ensures customers receive bills on time and get reminders when payments fall behind. Expense tracking apps sync with your bank accounts, giving you immediate insight into spending. With reliable tools in place, you save time, improve accuracy, and reduce the stress of manual tracking. This allows you to focus more on growing your business and less on worrying about unexpected cash shortages. If this video helped you understand accounting a little better, don't forget to like, share, subscribe, and turn on notifications for more accounting tips and guides.